Good morning, everyone. My name is Yashashwari Devi, and I'm from Group 6. Together with my group members, we will be presenting about non-current liabilities. We will begin explaining the nature of non-current liabilities, the relevant audit assertions and accounting treatments, the accounting system and internal control, as well as the audit procedures used to obtain sufficient and appropriate audit evidence. Without further ado, let's begin our presentation.
Hi everyone, my name is Shaza Iklima binti Sofyan and my matrix number is 0608024F1011. For this slide, I will present the new objective for our topic today. By the end of this presentation, we want to achieve four main goals, which is first, we will explain the nature of non-current liabilities. Second, we will discuss audit assertion and accounting treatment. Third, we will look at the accounting system and internal control. And then lastly, we will learn how to apply audit procedure to get enough audit evidence. Moving on to our first topic, what are non-current liabilities? Let's look at the definition. First, non-current liability are obligation or debt that a company need to pay back after more than 1 year from the reporting date. Second, they represent long-term financial commitment for the business. This means it is a long-term responsibility for the company. Some common examples of these are bank loan and bond. That is all for the definition. I will now pass to the next presenter to explain the characteristic. Thank you.
Now, let's look at the characteristics of non-current liabilities. Non-current liabilities are financial obligations that a company does not need to repay within the 12 months. Instead, they are usually settled over a longer period, such as several years. These liabilities often involve regular interest payment and are used to finance long-term investment, such as purchasing buildings, machineries, or expanding business operations. Examples of non-current liability are long-term bank loans, bond payables, lease liabilities, and pension obligations. For example, if a company borrows 2 million from a bank to purchase a new machinery and agrees to repay the loan over 10 years, this loan is classified as non-current liability because it is not due over 1 year. Understanding these characteristics helps auditor to determine whether the liabilities are properly classified and reported in the financial statement. Now we will move on to the next slide, which is audit assertions. We're going to talk about the relation between audit assertions and non-current liabilities. Audit assertions are claims made by the management regarding the accuracy of the financial statements. Auditors use these to assess whether the non-current liabilities are fairly presented. The first one is existed, which means the recorded liability actually exists. For example, a bank loan recorded in the accounts should be supported by a valid loan agreement. The second one is completeness, which ensures that all current liabilities are recorded. Auditors can check that the no loan or other obligation has been omitted. The third one is rights and obligation, which confirms that the company is fully legally responsible for repaying the liability. The fourth assertion is valuation, which means the liability is recorded at the correct amount, including any accrued interest or adjustment. The last one is presentation and disclosure, which is basically to making sure that the non-current liabilities are correctly classified in the financial statement and all required information such as repayment terms, interest rates is properly disclosed in the notes to the financial statement. By testing these assertions, auditors can provide assurance that the company's non-current liabilities are accurate, complete and fairly presented.
Good morning, everyone. Now I will explain the accounting treatment for non-current liability. First point is internal recognitions. That means a company receive a long-term loan, it is recorded at fair value. For example, we debit cash because the company received money and we credit long-term loan because the company now has a liability. Second point is interest expenses. That means every year the company records interest has expenses by debit interest expenses and credit interest payable. At the end of the final year, the loan is divided into two parts. First is the amount due within 1 year is classified as a current liability. Second is the remaining balance is classified as a non-current liability. Next, I will explain the accounting system and internal control. In this slide, we have two main points. First, let's talk about a good accounting system. The first point is record every loan accurately. This means all loan must be recorded correctly without any mistake. The second point is maintain loan schedules. This means the company keep track of when a customer need to make their loan payment. The third point is calculate interest correctly. This means the system makes sure the